Good to see you again.
Good to see you too. The market, I don't even know where to start. Like the equities are completely off. The metal prices are pretty strong. Conversely, there doesn't seem to be any, at least retail audience. What do you think? Where are we?
Yeah, it's very interesting. We're really rudderless at the moment. You and I were talking off camera about the sort of eras we've been through. Everything sort of starting to break on the China supercycle narrative around the Sino-Forest scandal in 2011, and then sort of an ongoing cascade over the next 4 or 5 years with Pine Tree defaulting on its debenture and Ned Goodman losing control of Dundee and Dundee Resources, and then finally, I guess, Eric stepping down as portfolio manager of Sprott Canadian Equity in, I think, January of 2015. And so we both lived through a very long bear market, and then the market got small enough for the capital available for it in 2016, and it started to grow organically again. And I think we're probably in a long cycle, but of course there'll be ups and downs, and we're definitely in a down right now.
Yeah. Well, talking about market cycles, it's definitely a question that's been on my mind. The importance of timing in the junior resource sector is paramount, following that flow of money. Mm-hmm. But when it comes to cycles, where are we? Where would you say, are we at the beginning, end?
I've been thinking a lot about that because really I think of the market inflection point as being January of 2016. And we had a very powerful rally, but on a little bit of volume and only a little bit of additional capital during 2016. But there were a couple of names that really exploded up, let's say, into the end of 2017. Certainly Novo Gold would be a great example of that. And a lot of companies during 16 and 17 were able to start raising 2 to 3 years worth of capital. So they could finally run a program and not be broke at the end of that program. And commodity prices were beginning to recover, and the sector, which had gotten so small in terms of aggregate market cap, really just needed a small amount of new capital coming in order to start a rally. But I don't think much new capital came in, and I think that you had early successes like Warner when doing very well on Sol Gold initially, and NextGen. Eric doing extremely well on Kirkland Lake. Richard Wark and Ross Beatty, who often are invested in the same stories, doing well on Ventana and Augusta, and then of course finally Arizona. And so the capital that brought the sector to the last high, which let's just say ended when Biden won his election, largely came organically. It grew inside of the business out of discoveries like the Swan discovery at Fosterville in Australia, and so that created $1 billion profit for Eric, literally $1 billion, which is incredible. But it also put Kirkland Lake Gold in a position where they could make large strategic investments, and they made, I think, a $50 million investment alongside Eric in Novo Gold. And that was the beginning of a huge, phenomenal story around the next Pilbara, the Pilbara being the next Witwatersrand, and an $8 stock price at the peak, and that, I think, launched Quinton and Crescat as players in the market. And so discovery created capital, created more discoveries, and more capital. But it seems like, at least at the moment, we hit a peak in capital, and we're receding. We're going a little bit backwards at the moment.
Right. And, is it going to take a discovery to change this market that we're in? Or is it just a matter of is it the fear of a recession that has to go away and for the market to see a bright future in commodities? Like, I guess you could have both, but what do you think needs to come to change the sentiment?
Well, I think capital's been flowing out of small caps for quite some time now with the small generalist participation, having decided almost a year or two ago that the Fed was going to create some kind of recession and that small caps would be punished the worst. And so I've seen outflows, generalist outflows, and again, there weren't a lot of generalists to begin with, but there were some intrepid friends of mine running small hedge funds or let's say sub-billion-dollar assets, assets under management, who like gold, who were looking for returns outside of the mainstream, away from tech, and they all are still interested in gold and copper and lithium and the battery metals suite. But most of them won't be in the small caps at the moment because in preparing for recession, they want to get rid of those companies which might not have the capital to get through it.
Right. In the news, one of the biggest rumors, and it started last year, the talk of the BRICS nations coming together and having a trading currency that's backed by gold. Mm-hmm. Just recently, in the last 2 weeks, we've seen reports, again, it's from Russian TV is the quotes that I'm seeing, and they're saying at the August meetings of the BRICS summit that we're going to see this gold-backed currency come to fruition. Let's say it does happen. Do you see that having a positive effect in the gold market?
I don't. I think there's just an irony and a paradox always around these sort of events, which are supposed to be seminal events for a commodity or some sort of an investment concept. I think that well, let me back up. It's great publicity for gold. Yeah. And I think that we were, as gold investors, which I am, somewhat victim to crypto and the rise of crypto over the past 10 years. I think they did a great job of getting a younger generation nervous about the money supply and about de facto political control over money. This what WTF happened in 1971 website. I mean, I didn't even know. It's brilliant marketing. And I think what was interesting about crypto and Bitcoin is you got a whole bunch of smart millennials or whatever the generation after that is, thinking about money and thinking about what it meant and thinking about political systems having excessive control over the money supply. And unfortunately, the way it wasn't just Bitcoin, but it was all this whole panoply of other cryptocurrencies, which apparently everyone could start one. So in the long run, I think that's going to be good for gold. I think that people concerned about hedging their currency exposure, people concerned about having an asset that's uncorrelated, that's all good for investment in gold. But I think that the primary villains in that story are government, and the government of the BRICS or the various governments of the BRICS getting together and deciding they're going to peg their currency to gold. A, I don't think that would ever hold, and B, they're the problem to begin with in theory. So also I just heard India was not interested in participating in this, and I think that if India doesn't participate, then
falls apart.
It does, yes.
I think one of the interesting concepts, like for me, I go back to my own personal experience. Like it was curiosity in monetary policy that sort of got me into precious metals, and then you go down the rabbit hole and junior mining stocks. So, do you think in this next cycle, for the juniors or maybe the junior gold companies, for them to attract that younger crowd, do we have to see them get interested in monetary policy or what money actually is, or the contrast to CBDCs? Does that need to happen for the general retail investor to come back into, or maybe even come in more into the equities?
Well, let's go back to Fosterville for a second, because I think this is one of the most interesting ways that these things happen in the business. The Swan and the Phoenix were incredible high-grade discoveries, and they generated cash flow very quickly. They were able to expand the mill at Fosterville within, I think, 2 years, and this gave Kirkland Lake and Tony McCooch, who was very aggressive, not just as a manager of a mining company, but also as an investor in other opportunities. This gave him the cash flow to start competing with other mining companies for strategic investments in in companies. It allowed him to team up with Eric and make large investments in concepts like Novo. And the whole thing had sort of a pro-cyclical, virtuous compounding to it. And when the equities began to perform, you began to attract more and more retail interest in the space. So I'm not sure that we need a bunch of spooky macroeconomic things to happen in order to drive retail into these stocks. I think these stocks just need to perform. And we don't really know where performance is going to come from. But what you see is when the producers are making money and when they have the money to go out and replace their reserves in the form of either bringing new mines on or, most importantly, investing in the juniors, you'll get retail follow-on. So what this sector really needs is positive free cash flow.
Okay. Talking about positive free cash flow, what was interesting coming out of COVID is the oil price had fallen, and I think it's probably one of the first times that I've seen valuations or free cash flow increase, because really the commodity prices, oil being the big one, didn't keep up with the gold price reaching new highs or staying at new highs. Mm-hmm. Moving forward with inflation being so prevalent, do you think that we're going to see a major increase in free cash flow, or is it just going to be incrementally move up because all the other prices are going to move up too?
Well, you've certainly seen it at Rio and BHP and South 32. So the base metal producers who have these long life assets that were important in various supply chains, I think did bumper business even during COVID. And Pilbara Minerals, the lithium company, I think that's the Talison assets, the Greenbush assets in Australia, I think had more free cash flow than the entire Australian gold sector last year. So it's hard to know where on the periodic table you're going to get free cash flow. I imagine that it's eventually going to find its way to gold and some of the better gold mines. And I think that the cost of various inputs to gold mining or silver mining, for instance, are coming down now, and certainly the urgency, and it's very, very ironic. It's hard to generate free cash flow for precious metals companies, but those are some of the shortest life assets in public domain, and so the urgency to replace reserves there is extremely high, and that in the end will drive M&A in the sector. And if you add some robust free cash flow to the mix, then I think you have the tinder that starts the fire.
In previous interviews and the times that we've spoken, you said the ingredients in a junior resource company you need is a scientist, a salesman, and a strategist. Another thing you've said is that the vast majority aren't going to have all three. So if you had to, maybe not rank, but if you're going to look at a junior, if they don't have all three, is that just a void, or can you get away with not having all three?
Well, the opportunity almost always comes because one of those chairs is unoccupied. Okay. And I'd say that if only one of those seats is unoccupied, then probably that's a problem that can be solved. And often a problem that can be solved by the shareholders of the company who can together give guidance to the company either strategically or who can promote the company. If two of those seats are unoccupied, you probably should think about putting your money other places. And unfortunately, often when two of those seats are unoccupied, the only seat that is occupied is the salesman's seat. And most junior mining companies are a salesman and a PowerPoint presentation, some very nice red blobs on them. And those ones I always think are probably voids. I mean, if you don't have a scientist, if you don't have something that ultimately can be valuable, then you probably don't have much. But strangely, the salesman-only companies often seem to trade well, at least early on in their lives.
Right. There's a book called The Battle for Investment Survival. It's authored by GM Loeb, who is a former New York broker. Mm-hmm. And in it, there's a quote, and I'm going to paraphrase because I can't remember it exactly. But basically, he talks about he said, prudent management of your investment dollars are concentrated. And when you can't go all into an investment or go all the way, as he states it, you're best to avoid it. Would you agree?
Yeah, I guess I feel rather the same way. I think that every great portfolio starts with 100% cash, and that ideas find their way in piece by piece, and then one day you have a full portfolio and probably not enough cash, which of course is exactly when markets crash. But I think I think that every idea should start as the most exciting, best idea that you have, and then the only thing that a prudent investor really needs to do is back off, take a break, and see if the investment itself has captured them, because there's some phase of promotion going on, or whatever phenomenon is driving the excitement and the opportunity is temporary in and of itself. And once you've allowed your own emotional state around the investment to sort of moderate, then you should think about starting the process of buying it. And the process of buying anything, especially in markets that are liquid, and really junior markets are all about renting your own liquidity to people who don't have the patience or the time or the luxury of time. You really need to average in, and slowly and over time, in my opinion.
Does the time value of money play into it all for you?
Well, it does, and this is one reason why you don't want to allow your excitement to cause you to take a full position in a stock in one purchase.
Right.
I think almost all natural resource companies are subject to seasonality, and in particular, exploration companies or development companies even have a seasonality to them, and when they're generating news and they're topical, excitement seems to peak, and when inevitably they hit a season or a time when they won't be generating news, interest recedes.
Yeah.
And that's really when you want to buy. So it's hard, but you get excited about a good idea. Maybe you like the theme of copper, and for instance, you love the idea of buying Trilogy in Alaska, which is a name I talk about an awful lot. Very, very easy to get excited about those assets. Very easy to get excited about copper. But of course, this is a company that generates news really only once a quarter, and often the news is generated for it out of Washington, and lately hasn't been good. So those are it really is important to think about any position as one that you will build over time, and hopefully during periods when interest is at small cycle lows.
You talked about starting with a large cash position and the ideas kind of flowing in. Mm-hmm. Do you look to keep a certain percentage of your portfolio in cash at any given time, or is it, again, more fluid?
Cash or liquid securities, something that you can liquidate in a day, okay, or a week tops. So I think you can measure your own liquidity based on the cash you have in the bank and that cohort of securities that you have where the position itself could be sold, let's say in 5 days, without having an unnecessary market impact.
Right. The role of mentors, I can't under explain to prospective investors. Like, they play such a big role in my life and the success that I've had. For you personally, how have mentors, or have they impacted you and the success that you've had?
Well, I'd say that I was mentor-free for probably most of my life until, let's say, my early 30s. And as a result, it took me a long time to complete my formal education and to get into business. And then when I finally found my way into business, it was at a very low level, working as a CPA at Price Waterhouse. But I started to meet some really exceptional people on my client assignments, and eventually got hired by a group at a Toronto Polar Capital, and this was a very interesting collection of entrepreneurs. There was a hedge fund there, there was a merchant bank, and sort of a private equity, small private equity or software fund. And so there was a great old-style macro trader in Paul Sabrin there, and a fantastic technology and software investor named Reed Drury there, and Vaughn Kololian was there, who'd been one of the partners at Gordon Capital. And it was a very interesting collection of sort of the best of Canadian finance. Reed had worked at Helix, which was one of the original venture capital funds out of Toronto doing software investments. Paul was the youngest director in the history of Burns Fry, and was there during some very famous incidents in capital markets in the 1990s. And Vaughn was sort of out of big money in Canada, and very, very well connected, and it was just a great place to work. And there wasn't a job for me there. They had a collection of investments, and some of them were required hands-on operation. They didn't have time to do that, and so they were constantly looking for young foot soldiers to come in and help out on those things. And I got one of their particular problems, one of their particular headaches in 1999, and that started my life working with them. And I feel very lucky to have been around these guys who just really, really had this fundamental experience in markets and at every part of the in every sector, really.
Right. You talked definitely about the in-person, and that's definitely, for me, it's been the kind of X factor, over the top. But when I first started, it was very much me reading books, watching YouTube interviews, and kind of connecting with certain personalities that I respected. So do you think it's possible for the retail investor out there to do that in-personally? They're not going to be able to necessarily reach out to successful people in the sector necessarily, but can they still be successful?
Well, I like to think yes, and I think especially in these markets, and especially today, individual investors are at a tremendous advantage. In a market where capital flows are driven by these large passive vehicles, I think there are rules-based systems that have to buy securities. They have to buy Tesla, they have to buy NVIDIA, they have to buy Uber, because all of these passive strategies favor size and liquidity or index inclusion. And then when you move to smart beta, the rule book is around those same factors, but then you add a few other smart factors. And if you are an individual investor and you want to step outside of those concepts, you're looking at some very large pools of capital who have to follow rules, and you don't. And then if you look at the active investors out there, the guys who are still running money for performance fees and who, in theory, are not investing in indices, they're measured quarter by quarter. And their cycles of redemption and subscription are very volatile these days. The individual investor doesn't have those problems and can merely step outside of those systems and look at the rules that they have to follow, and look at the liquidity, the ebbs and flows of liquidity into and out of active, and can buy securities and hold them for a longer period of time. And given the advent of discount brokers, the fees aren't that high anymore. So I actually think that this is sort of maybe one of the best times in history for individual investors. And if you move down to this particular sector, which is very undercovered, there's no research coverage for natural resource companies to speak of. Once you get out of the top, let's say 10 in every sector, this is really the dream of a diligent investor who can do their own research and who can find some time to travel and go to site visits, and who will go to conferences and meet CEOs and talk to them. I think this is tough, emotional, but a great place for individual investors to find an advantage.
Certainly. talking about those points, do you think conferences is really the big X factor? I don't know. Like, again, I go back to my experience all the time, and I think going to conferences like PDAC and some of those big ones and being able to meet the companies in person, because that's one thing at the very beginning I was a little bit sheepish in calling, getting on the phone and talking to these guys. And the conferences, I think, really brought me out of that shell and being able to talk. So do you agree with that?
I do. I think they're incredibly valuable, and as I think that's where you and I met.
It is.
All those years ago. I think we first said hello at a metals investment forum in Toronto, but we would see each other at conferences before that. And I think what's fantastic about them is the companies like to attend. It's an opportunity for them to market with some scale, the scale being supplied by the conference operator. Investors like to attend, and it's a great place for cross-pollination to occur. Investors can talk to each other about experiences that they've had, and all the companies you're invested in are often there, and companies that you may wish to consider investing in are there. And I think one of the reasons that they're so valuable is at least most of the big operators operate them quarterly. And it's a super, super important thing in this business to talk to your companies on a regular basis and pay attention to how the story has changed. Especially companies that are not producing news for long periods of time, that are waiting for drill results to come, or that are waiting for some permit or some sort of an external event to occur. It's always very interesting to talk to those companies monthly or quarterly and listen to the way they construct sentences around the same subject. And think about their inflection or their mood. And so the conferences are a very easy way to sort of visit with these guys periodically and talk to them face to face, where you get a lot more body language and other potential signaling.
Yeah, that's a really good point. Risk. And it's something that any junior resource sector investor is going to be well acquainted with. But I want to talk not just investing in whatever comments you want to make, but let's talk risk in life. Can you, if financially speaking here, can you get or attain financial freedom without taking some form of risk in your life?
That is a very interesting question, especially as it pertains to this business, natural resources. There are capital providers in this business who I think seek to make money without taking risk. And this is why we see so many unit deals in this business, where companies finance themselves by giving away a share and a warrant. And some of the most well-known personalities in our business talk about waiting for full 5-year warrants, and talk about only investing in unit deals and never buying in the stock market. And I greatly respect those individuals. The ones I'm speaking of, the Rick Rules, the Marion Katuses of the world, they really know what they're doing. And I think that the drawback to that is rental capital is the first to leave these companies and devastate their stock prices. And so if there was only non-risk seeking rental capital in this business, it would never operate. And if you are not an accredited investor, or you just don't have the capacity to participate in financings in a meaningful way, so you get kicked off lists, or you get tiny fills on lists, you have to look to take advantage of the presence of that block of capital by buying when that capital leaves a name behind, but leaves it in good enough shape that it can still move forward in its business plan. So my own personal way of playing in this business or trading in this business is to think about where a company has potentially sourced high velocity or rental capital, and whether or not after that capital has left its stock price in bad shape, whether or not there's still enough talent and money to get the job done. And I think that's a fantastic source of alpha in this business. But it is risk in its purest form. You're just probably getting it at the best price.
Okay. Dave, I really appreciate your time chatting with me, and hopefully we can do it again soon.
That's great. Great to see you, Brian. Cheers.